Greetings, everyone, and welcome to the Climb Funds tutorial on financial ratios for small businesses. In today's lesson, we're going to examine how to apply financial ratios to a balance sheet. As a business owner, understanding the financial health of your company is vital for making informed decisions that can drive growth and efficiency. Financial ratios are powerful tools that allow you to analyze the balance sheet and extract meaningful insights that go beyond just the raw numbers. These ratios can help you pinpoint areas where your business is performing well and identify opportunities for improvement, ultimately leading to enhanced operational efficiency and profitability. Now, in this video, we're going to cover 6 essential ratios that every small business owner should know: the current ratio, the quick ratio, the debt to equity ratio, the debt to assets ratio, profit margin, and return on assets. By assessing these ratios, you'll be able to evaluate your company's liquidity, financial leverage, profitability, and overall asset management. For example, the current and quick ratios will give you insight into your ability to meet short-term debt obligations, while the debt to equity ratio and debt to asset ratio will help you assess how much risk your business is taking on by using debt. Profit margin and return on assets will show you how effectively your business is converting sales into profits and utilizing its assets to generate income. Now, by regularly tracking these ratios, you can make data-driven decisions to streamline operations, optimize cash flow, and reduce financial risk. Whether you're looking to improve liquidity, enhance profitability, or leverage your resources more effectively, these ratios provide the metrics you need to take actionable steps towards a healthier and more profitable business. Now let's dive in and explore how you can apply these ratios to improve your company's performance. Now, before we start looking at these ratios, we should probably answer some questions about them. First of all, what are financial ratios? Well, financial ratios are key metrics used to evaluate the financial performance and health of a business. They are calculated from the financial statements, such as the income statement, the balance sheet, or the cash flow statement, to provide insights into various aspects of a company's operations, such as profitability, liquidity, solvency, and efficiency. Next, you might be wondering, okay, I understand what a ratio is, but what am I going to use it for? So there are many different ways that we can apply the information that we extract from financial ratios. Firstly, we can use it to assess short-term financial health. Next, we can use it to evaluate creditworthiness for lenders. We can also use it to identify cash flow or liquidity problems. Perhaps one of the most powerful ways to use ratios is to benchmark against other industry standards. So look at your top competitors in your industry. You know, if the company is not publicly traded and you don't have access to their financial statements, you want to get this information, other business owners may be a bit hesitant to give you their direct financial statements. But if you ask them a more pointed question about, hey, what does your quick ratio look like? Or what does your current ratio look like? Well, they may be more likely to give up this information than the direct information off of their balance sheets, the raw numbers. We can also use these ratios for strategic decision making and tracking changes over time. So to track changes over time, a good exercise is really to, after you read your financial statements every month, take a few of these ratios, apply them to your financial statements, and then save that data, and then do the same next month and the month after and the month after. Before you know it, you'll have a couple years worth of financial statements with ratios to go along with them. And you can look at how the ratios are changing over time. Are these changes good changes? Are they bad changes? Um, you know, this is what the data can do for you. And, here at Klein Fund, we're always telling our clients how important it is to sit down with your financial statements every month, read them, examine them, see what they have to say. And so these ratios are going to be another step of progress in that direction. It's going to help you add to the amount of insight that you can extract from these financial statements. Um, so with that said, let's go ahead and get into these ratios and take a look at what they can do for us. So go over to our balance sheet. Now, you guys may recognize this balance sheet. It is the same balance sheet that we used in our Basics of Financial Statements tutorial. The only difference with this balance sheet and the original balance sheet that we used in that tutorial was I have added accounts receivable to this balance sheet at a rate of 10% of the monthly sales. Um, Other than that, this is the same balance sheet we used before in that tutorial. So if you'll remember, we had the original balance sheet before the company opened for business, and then we had a balance sheet after month one had been completed. And so we can see the changes from, the bank account went up, the inventory dropped, all the changes that you would expect to see after 1 month of operations have been completed. Um, and so let's move on over and take a look at these ratios and what they can tell us. So the first ratio that we're going to examine today is a couple of liquidity ratios. Now, when I say liquidity ratio, what I mean is it's a ratio that measures a company's ability to meet its short-term debt obligations. And so the current ratio is the first one that we're going to look at. The current ratio helps assess the liquidity of a business. Now, a ratio of above one indicates that the company has more assets than liabilities due within the next year, meaning it should be able to cover its short-term debts. A ratio below one may signal potential liquidity problems, indicating that the company might struggle to pay its bills on time. Now you can see over here on the right of current ratio, we have what healthy ratios are generally considered to be. Now, the current ratio, generally you would prefer it to be in the range of 1.5 to 3. And that basically means that you say if it was a 3, you have a 3-to-1 coverage for uh, assets, current assets to current liabilities, and you should be able to pay all of your short-term debts on time. Now, also here, we can see the formula for the current ratio, and that formula is current assets divided by current liabilities. So let's go ahead and enter that into our cell and see what we get. So we're going to start by saying equals. Then we want to look at our current assets. We come over to our balance sheet, current assets, G9, and we want to divide that by current liabilities. Current liabilities, G22. And then we hit enter. Now, remember, we said that a healthy ratio, a healthy quick rate or current ratio is anywhere from 1.5 to 3. Now, with a current ratio of 12.24, what does that mean? Well, it means that we have $12 of asset to every $1 of debt, basically. And so that tells us very quickly that we should have no problem covering our current liabilities. And if you want proof of that, let's just take a look. Current liabilities. So we have payroll taxes of 1,000, and we have sales tax of 32, 40, and 45 cents. So our total current liabilities, $4,240.45. And we can look at our bank account right there, 46, almost $47,000 in it. So we should be able to easily take care of our current liabilities. So that matches up. Um, it passes the eye test. And our current ratio tells us that we are in a healthy position to pay our bills for the next month. Now, why is the current ratio so far above what we would consider to be healthy? Well, we need to keep in mind that this is this business's first month in operations. If we look at the inventory, it started at $20,000 worth of inventory. We drew it all the way down to just under $2,000. So we had a very good month. We nearly turned over our entire inventory. Um, and so we would expect a company that on a monthly basis almost completely turns over its revenue. We would expect them to be in a favorable cash flow position. And this current ratio absolutely looks like this company is in a very good cash flow position. Next, we're going to take a look at the quick ratio. Um, Now, let's take a look at this formula for the quick ratio. Um, Cash plus cash equivalents plus accounts receivable. We take that total and we divide it by current liabilities. Now, you're probably asking, what in the world is cash equivalents? Well, cash equivalents are short-term, highly liquid investments that are easily converted into an amount of cash and are subject to an insignificant risk of changes in value. Typically, these assets have a maturity period of 3 months or less from the date of acquisition. So some examples of these would be money market funds, treasury bills, certificates of deposit, commercial papers, and bank drafts. Um, Now, most small businesses, most startups in the first couple years of operations are not going to have cash equivalents laying around. But as a business matures, gets older, it gains more assets, um, you know, you start to look at cash equivalents as something that may be beneficial to having on hand. So if your business is not yet in a place where you have cash equivalents, we'll just leave that out of the equation. And if we take cash equivalents out of the equation, what are we left with? Well, we're left with cash plus accounts receivable. And then we'll divide that by current liabilities. Now, again, looking at what is a healthy quick ratio. So a quick ratio that is healthy is generally going to be in 1 to 1.5. Now, one thing I want to say about a healthy quick ratio or a healthy current ratio, these numbers can definitely change from industry to industry. Sometimes an industry is an outlier with regards to what is a healthy current ratio or quick ratio. So we don't want to make a blanket statement that it's 1.1 to 1.5 for every business. But generally speaking, for most businesses, 1 to 1.5 would signal a healthy quick ratio. So it's important to keep these things in mind, such as the size of your business, the industry that you're in. These can have an effect on what is healthy or not healthy. Um, but generally speaking, as a general rule of thumb, if you're a run-of-the-mill small business, these are numbers that you can abide by. And if you have question about whether these numbers apply to the industry that you're in, just do a quick Google search. Ask Google, what is a healthy current ratio for the food and bev industry or whatever industry you happen to be in. All right, so now that that's said, we can take a look at the quick ratio. Now, so we said cash, so we're going to start by saying equals, go over to our bank account because that is our cash. Actually, first, let's delete that. We have to add a couple of things together. So we're going to go open parentheses. Then we're going to put our cash in plus. Then we're going to add our accounts receivable in. Then we're going to close the parentheses. And then we're going to divide that by what? By our current liabilities. So then we go over to our current liabilities, select, and then enter. Again, we see that this company has a healthy, very healthy quick ratio. So for every dollar of debt, this company has $11 of assets. And again, the reasoning for why this company has such a good quick ratio, it's pretty much the same reasoning. Why does this company have a good current ratio? Basically, they have turned over almost the entire inventory in 1 month. And generally, when you do that, um, good things happen. And so we see in terms of liquidity, this company is very, very healthy. Now, again, the company just got off the ground, just finished its first month of doing business. So if all we have is one data point of 12.24 for a current ratio, 11.77 for a quick ratio, we want to hold off on saying, yeah, my company or this company is going to be the next big thing. We want to see what these ratios do as time stretches out, as more and more unexpected things happen to the company, up times, down times. Um, so with just 1 month of data, be hesitant to put too much emphasis on that one data point. But after you get 12 months, 24 months, 36 months of data to sit down and consider, we can start drawing more concrete conclusions about the performance of our business once we get that amount of data built up. So next, we're going to switch over to leverage ratios. Now, again, we need to do some explaining on what do we mean by leverage ratios. So leverage ratios indicate the level of a company's debt relative to its equity or assets, showing its financial risk. And so what is leverage? Well, leverage is debt. And we are basically trying to get an idea with these ratios. What does the debt situation look like for this organization? Is it in a good debt situation? Is it in a bad debt situation? Well, let's go ahead and run these numbers for the debt to equity and the debt to asset ratios and see what they tell us about the company. And again, we want to know, well, what is a healthy ratio? So a healthy debt to equity ratio, we're looking at a 0.5 to a 2. And again, you guys heard my disclaimers about what is a healthy ratio and how it can change from business to business or industry to industry. So keep that in mind. But we should also say a little bit about exactly what a debt to equity ratio is. Now, the debt to equity ratio is a key metric for assessing financial health, managing risk, and making strategic decisions about funding and growth. A good understanding of this ratio helps small business owners optimize their financing approach and maintain a balance between leveraging debt and preserving financial stability. A ratio that's too high could signal financial instability, while a balanced or lower ratio can indicate prudent financial management, which may help secure future funding or attract investors. So now that we know what the debt to equity ratio can do for us and what it is, let's calculate it and see what our debt to equity ratio looks like. So total debt, that would be total liabilities, right? Because we know our liabilities are our debt. So we're going to go equals. We're going to go down to our total current liabilities and our total long-term liabilities. We're going to add them together. So current liabilities plus long-term liabilities. And we're going to divide that by total equity. Now, we can see here after doing this very basic math to give us a debt to equity ratio that we have a ratio of 1.11. Now, when we look at our healthy ratio range, a 0.5 to a 2 is generally considered a healthy debt to equity ratio. So let's move on to debt to assets and see if that's any different. So debt to assets, we're looking at total debt versus total assets. And to give you a little bit of insight on what the debt to assets ratio does for us, uh, let's take a look at it. Now, the debt to asset ratio is a financial metric that shows the proportion of a company's assets that are financed through debt. Small business owners can use this debt to asset ratio to guide strategic decisions about taking on new debt or investing in assets. A business with a low debt to asset ratio may have more room to borrow money for expansion or new projects without overextending itself. On the other hand, if the ratio is too high, lenders might be hesitant to provide additional financing, and the business may face higher interest rates due to the perceived risk. Um, so now that we've said all of that, we know a little bit more about the debt to assets ratio. Let's calculate it, see where we fall. So total debt, we're going to go equals. We're going to go total current liabilities plus total long-term liabilities, parentheses, divided by, oh, divided by total assets. Now, healthy ratio for debt to assets generally between a 0.03 and a 0.05. Now we look at what we got, 0.53. So we are at the upper end of the healthy range for debt to assets. So far, through current ratio, through quick ratio, through debt to equity, through debt to assets, each one of these ratios has shown that the company is in a strong financial position. So now, lastly, let's move on down and let's take a look at profitability ratios. So what is a profitability ratio? Well, a profitability ratio assesses a company's ability to generate profits relative to its revenue, assets, or equity. So for profitability ratios, we are going to examine two different ratios. We're going to look at operational profit margin, and we're going to look at return on assets. Now, the profit margin is something you hear a lot if you're listening to, webinars, if you're reading business news constantly, you'll hear the term profit margin come up and, maybe you don't always understand what exactly that refers to. So, um, the Operating profit margin is a financial metric that shows what percentage of a business's revenue remains after covering its operating expenses, such as rent, salaries, utilities, and other costs related to the core business operations. The operating profit margin helps small business owners assess how they're managing day-to-day operations, and a high margin indicates that the business is efficiently managing its operating costs, while a low margin suggests there may be inefficiencies in the operational structure. So, what is a healthy operational project or operating profit margin? For most businesses, 10 to 20% is a really good number. Again, these health metrics are going to depend on size of the company and on the industry that you're in, but that's a good rule of thumb for 10 to 20%. So we're going to have to look at net income divided by net sales. So net income and net sales are not going to be found on the balance sheet. Instead, we're going to have to go over to our profit and loss sheet to find those numbers. So we see our net income down here. See our total sales up here. So let's go back over to our balance sheet. So we want to say equals, and we're going to go down to our net income divided by total sales. Enter. And so we can see here that we have got a 24% profit margin or operating profit margin. We said that 10 to 20% is generally a rule of thumb for a good operational profit margin. So again, we see that this company is in a good position with the first profitability ratio. So that's going to bring us to our final ratio, and that one is called return on assets. So what is the return on assets ratio? Well, the return on assets ratio is a financial metric that indicates how efficiently a company is using its assets to generate profit. It shows the percentage of profit a business generates for each dollar of its own assets. Return on assets is a valuable tool in decision making. If a business owner wants to grow or expand, they can use return on assets to assess whether their current assets are being utilized to their fullest potential. If assets are underperforming, it might be wise to hold off on further expansion or consider reallocating resources. A consistent, healthy return on assets indicates that a business is likely well managed and financially sound, as it is generating profits relative to the assets it holds. A declining return on assets may signal operational problems, poor management, or the need for strategic adjustments to improve asset efficiency. So now that we've said a little bit about return on assets, let's take a look at the formula. So we're going to be looking at net income, which we used on our profit margin, and we're going to be looking at total assets. And so go over to our healthy range for return on assets, and that is generally 5 to 10%. So let's do the calculation and see what we've got for our return on assets. So we're going to go equals. We're going to go over to our P&L to get our net income. We're going to go divided by, then we'll go back to our balance sheet for total assets and enter. And so we have a 9% return on assets. And as was the rest of our assets, or as was the rest of our ratios, this is falling in line to a pretty healthy return on assets ratio. So after 1 month of operations, we can see that these ratios that we've examined all indicate to us that this company is in a pretty good position with regards to its liquidity, with regards to its leverage, and with regards to its profitability. Now, as I said, we don't want to put too much emphasis on these numbers because this is only 1 month and this is the company's first month in operations. So, you know, whenever we are using data to make decisions, we want to have as much data as possible. So just keep in mind what I said about, tracking these on a month-to-month basis, getting a good collection of data before you start really trying to make strategic decisions based on what the data is telling you. Um, and I also think it's important to point out that this is not meant to be the end all be all video on financial ratios. There are many, many, many more financial ratios that you can apply to your balance sheets and profit and loss statements. Um, this video is just meant to be an introduction to this stuff. So, I've walked you guys through some of the the basics of it. But I'm going to encourage you to continue reading, continue educating yourself. There's so much more to learn about ratios and how they can benefit your business. Um, and I just want you guys to be aware that this is a thing um, that you can apply to your balance sheet. You can apply to your profit and loss on a monthly basis to get extra data points, to get you away from the raw numbers, and just give you a little bit more to consider. So I encourage you guys to apply these ratios to your financial statements on a monthly basis. See what kind of information you get out of them, and then use that data as you are plotting out what does next week look like, what does next month look like, what does next year look like, as you're plotting, the future course of your business. Um, Listen to everything that your financial statements are saying to you. Um, so that's it. This is the uh, financial ratios for small business. I want to thank you guys for joining me today, and we'll be back again with some more on the Climb Fund Entrepreneurial Elevation Series. Thank you so much.